Absolutely. Our next guest has an insight into that, into the trading out there. Matthew Vagari, head of research at Clearwater Analytics, joins us live here in our studio. Matthew, thanks so much for joining us here. Just briefly tell us what you guys do at Clearwater. What's your platform?
Great to see you again. We are an investment management platform that sees over 10 trillion in assets flowing through our system every single day. And that's across institutional investors like insurers, corporates, asset managers, hedge funds, you name it. And I can probably tell you something about it.
So what did you see on your platform over the last 6-7 weeks here?
What you just said is exactly right. We saw a pretty, would you take private wealth investors, for example, we saw a pretty material uptick in transaction volume. So people are actively trading, but are they really readjusting their portfolios from, dumping equities and buying fixed income and vice versa? Not that much tactical shifts across assets, but a lot of movement within assets. Be it for equities, still continue to chase the AI trade, believe it or not, and getting rid of consumer stocks, for example, that are particularly exposed to an energy shock.
Okay, so we're 7 weeks into this war in Iran. We don't know how much longer it's going to last, but we're all bracing for a lot of uncertainty. What is your confidence that this level of activity will continue in the next 7 weeks or the 7 weeks after that? I mean, if this kind of uncertainty prevails, will your clients continue to be this active?
I think so if you look over the last week or two, transaction volume has dipped a little bit relative to where it was for the first 2 weeks of the conflict. And if you look at oil, it's a little bit more subdued now, not trading as high as it was, let's say, even 2 weeks ago. I think as long as this conflict endures, those price pressures are going to start to build up. And right now, I think markets are really sanguine about recession risk in the U.S. economy. And we're absolutely going to see an uptick in volume and transaction activity on our platform, because right now, I think there's a little bit of a wait and see. And as we start to see a little bit more, investors are definitely going to act.
So from your perspective, I mean, are you forecasting a recession here? Because it seems like the economy's hanging in there, the consumer's hanging in there. We got some good numbers, results from the big banks over the last several days.
I think I liken the economy to a bit like a boxer that's been taking a lot of knocks over the last few years. You just heard the IMF managing director talk about a layer cake, if you will. I think of it more of a boxer that's been punching back well above his or her weight. But the problem is that the boxer's gotten tired. And if you look at the US, for example, we're not really producing any jobs. So what's been propelling the economy? It's been consumer spending driven by real income gains, wages that have been outpacing inflation. But wages pressures have been coming down because the labor market has gone softer. But you're telling me that we might be adding something like 1 point plus to inflation? That's going to put real wages underwater. We're not producing enough jobs. I just don't know what's going to be propelling the economy forward, call it 4-6 months from now, if this energy shock does persist.
And you don't see it as something from the Federal Reserve. There is no Fed put here that can give markets and give investors some new lease on life. No,
I like to tell our clients that the difference between a recession and no recession is not 100 basis points on the Fed funds rate, right? The Fed is going to be it knows that inflation is coming, but it doesn't know yet that the labor market will unravel. So it's going to have to wait to see what happens with the labor market and basically press the pause button as it knows inflation starts to enter into these CPI prints.
So what do you expect the Federal Reserve to do this year? To sit on its hands, or?
I think unless the labor market unravels really quickly, which is not my base case, I think this Federal Reserve is going to have to sit on its hands and probably not cut. And markets, I wouldn't be surprised if they start looking the way that the Bank of England and the ECB have been looking, which is the likelihood increasing for even raising rates by the end of the year if inflation does rear its head again.
How are you thinking about private credit? Because a lot of the family offices, it's reported that they might be behind some of those withdrawal requests from the private credit funds. And certainly there's a lot of nervousness, even as a lot of the private credit funds have largely held up. The loans haven't necessarily all gone bad. Of course, there's some sectors are more vulnerable than others. Is there a risk of this becoming something bigger, a contagion?
That's a really great question. I can tell you that I can see firsthand that we are seeing that with certain private wealth investors absolutely withdrawing from private credit funds. What I will also note is that we were able to look back at Q1 performance, kind of decomposing it week by week across asset classes. And because bonds got pummeled from the potential for increased inflation, because equities got pummeled initially, because of, again, this energy shock, what actually served as a ballast was private credit. Those who stayed in the game had those strong 9, 10, 11% income gains conferred to their portfolios. And actually, when I talk to clients, I say this is the feature, not the bug of private credit. It is a diversifier, and for those who are using it for its intended use, they're seeing the gains from it. Will that result in continued bank runs, going forward if these headlines continue to dominate? That seems likely, but for those who have stuck this out, it's definitely benefited them.
So real quick, alternatives in general, what are you seeing on your platform?
We are seeing, I think, a pause, a wait and see. With private credit, there has been certainly a desire to reduce exposure for some clients and institutional investors. But for a lot of alternatives, we have to remember that these are long-term, long time horizon investors. Take insurers, for example. They're not thinking 1 quarter from now, 2 quarters from now. They're thinking 5, 10 years from now. And so they're not likely to pivot away from alternatives anytime soon.
Yeah, they need it as that diversifier.
Absolutely, and that's what it's there for. Matthew Vigari, thank you so much for joining us. Matthew Vigari, he's head of research for Clearwater Analytics, joining us live here in our Bloomberg Interactive Broker studio. Red and green on the screen here today, kind of keeping with that theme. The S&P's up 20.